An equity swap is a financial derivative contract where a set of future cash flows are agreed to be exchanged between two counterparties at set dates in the future. The two cash flows are usually referred to as legs of the swap. One of these legs is usually pegged to a floating rate such as LIBOR. This leg is also commonly referred to as the floating leg. The other leg of the swap is based on the performance of either a share of stock or a stock market's index. This leg is commonly referred to as the equity leg. Most equity swaps involve a floating leg versus an equity leg, although some exist with two equity legs. An equity swap involves a notional principal, a specified tenor and predetermined payment intervals. Equity swaps are typically traded by Delta One trading desks. Examples: parties may agree to make periodic payments or a single payment at the maturity of the swap. Take a simple index swap where Party A swaps A £5 million at LIBOR plus 0.03% against A £5 million. In this case, Party A will pay a floating interest rate on the A £5 million notional and would receive from Party B any percentage increase in the FTSE equity index applied to the A £5 million notional. In this example, assuming an LIBOR rate of 5.97% PA and a swap tenor of precisely 180 days, the floating leg payer equity receiver would owe A £5 million 180/360 equals A £150,000 to the equity payer floating leg receiver. At the same date, if the FTSE had appreciated by 10% from its level at trade commencement, Party B would owe 10% by our £5 million equals A £500,000 to Party A. If, on the other hand, the FTSE at the 6-month mark had fallen by 10% from its level at trade commencement, Party A would owe an additional 10% by our £5 million equals A £500,000 to Party B, since the flow is negative. For mitigating credit exposure, the trade can be reset, or marked to market during its life. In that case, appreciation or depreciation since the last reset is paid and the notional is increased by any payment of the floating leg payer or decreased by any payment from the floating leg payer. Applications: typically equity swaps are entered into in order to avoid transaction costs, to avoid locally based dividend taxes, limitations on leverage, or to get around rules governing the particular type of investment that an institution can hold. Equity swaps also provide the following benefits over plain vanilla equity investing. An investor in a physical holding of shares loses possession on the shares once he sells his position. However, using an equity swap, the investor can pass on the negative returns on equity position without losing the possession of the shares and hence voting rights. For example, let's say A holds 100 shares of a petroleum company. As the price of crude falls, the investor believes the stock would start giving him negative returns in the short run. However, his holding gives him a strategic voting right in the board which he does not want to lose. Hence, he enters into an equity swap deal wherein he agrees to pay Party B the return on his shares against LIBOR plus 25 bps on a notional amount. If A is proven right, he will get money from B on account of the negative return on the stock as well as LIBOR plus 25 bps on the notional. Hence, he mitigates the negative returns on the stock without losing on voting rights. It allows an investor to receive the return on a security which is listed in such a market where he cannot invest due to legal issues. For example, let's say A wants to invest in company X listed in country C. However, A is not allowed to invest in country C due to capital control regulations. He can, however, enter into a contract with B, who is a resident of C, and ask him to buy the shares of company X and provide him with the return on share X, and he agrees to pay him a fixed/floating rate of return. Equity swaps, if effectively used, can make investment barriers vanish and help an investor create leverage similar to those seen in derivative products. Investment banks that offer this product usually take a riskless position by hedging the client's position with the underlying asset. For example, the client may trade a swap, say Vodafone. The bank credits the client with 1,000 Vodafone at £1 and 45 pennies. The bank pays the return on this investment to the client, but also buys the stock in the same quantity for its own trading book. Any equity leg return paid to or due from the client is offset against realized profit or loss on its own investment in the underlying asset. The bank makes its money through commissions, interest spreads and dividend rake-off. It may also use the hedge position stock as part of a funding transaction such as stock lending, repo or as collateral for a loan. See also, contract for difference.